And what we do is different. And what we try to tell people is that it may be simple, but it's not easy. Okay, what we do, it takes consistency, it takes predictability. Another thing that I think really differentiates who we are, and it's going to be tied to your question a little bit, but it's a little bit off of it, is that we focus so much more on the downside. I mean, our firm adage has always been the same. We absolutely focus on what's the worst case scenario, how do we get hurt, how does somebody do us wrong, what could blow up in our face, etc. Because if we can live with that worst case scenario, the upside will take care of itself.
Christopher, welcome to the show.
I'm happy to be here. Thank you for having me.
For our listeners who haven't had the opportunity to get to know you, can you maybe just take a moment and introduce yourself and your firm to help us orient for the rest of our conversation?
Sure. So I'm Christopher Zook, founder and chief investment officer of CAZ Investments. We're based in Houston, Texas. And we're a firm that invests in basically everything under the sun, anything, anywhere, anytime. And we'll get into more of that, I'm sure, in a bit.
That's a big tent, and I'm excited for our conversation because you sure do a lot. But before we get into that, I always like to start my conversations by understanding the origin story and a little bit about my guests and where they grew up. And you have a particularly interesting upbringing. Why don't you kind of talk us through where did you grow up and what was your journey into private markets and investing?
Sure. So I grew up in Houston, Texas. I've been here my entire life, except for 4 years that I'll come back to in just a minute. But grew up in a very modest upbringing, grew up in a family that, basically was split when my folks got divorced when I was basically 12 years old. And so I learned really, really quickly how to grow up. And some would argue that I grew up a little bit too fast. I was told by somebody when I was 14, I was the absolute youngest looking 40-year-old that they'd ever seen. Because I kind of carried myself like a much more mature person because I effectively became the man of the house at basically 13 years old. And so that informed, kind of who I became and how I went about accomplishing what I wanted to accomplish. But I had two really great things that it did for me. And Tony Robbins says all the time, life is either happening, to us or for us. And there are definitely times that I felt like it was happening to me. But I was able to kind of redirect that long before I knew Tony, which I'll come back to in a minute. But I was able to basically say, okay, I have a couple of choices here. I can decide to be the best that I can be and to work my tail off to become that, or I could just become, a statistic, et cetera. I was blessed to be able to be a good athlete, and I had the opportunity to play football and other sports going all the way into high school, and then ultimately football in college and then golf. But, I learned more than anything else that hard work mattered. And I learned that there's only really one thing that every single person can control, and that is their calendar, that is their schedule, and that is their effort. And so, for me, the saying now that I use is we all have the same 168. We all have the same 168 hours in the week, and we have the choice of how we spend those. There's a saying sometimes that my team will use that sleep is optional. It's not optional. It's really important to one's health, but we have the choice of how much we decide to spend our time with. And so I worked all the way through from the time I was a sixth grader all the way up until today. I have never not worked in my life. And it was really valuable for me to be a very successful athlete, also have to work to be able to put, to buy a car, to put gas in my car, and then ultimately to help pay for my college. Because while I was a good athlete, I did get the opportunity to play football at Texas Tech. I was too small to play strong safety in what at the time was the Southwest Conference, but I was good enough to be on the team, and I played corner there until a second knee injury took me out of the game. I took up the game of golf my sophomore year, walked on my junior year, missed it by a shot, walked on my senior year, made the team. Wasn't good enough to travel, but I was good enough to be on the team, which made me really a better player because I got to play with people that were much better than me every single day. But even while in school, in college, I had to work. I had to pay for my school. I started trading commodities as part of that, really kind of took like a duck to water in the trading aspect of the world. So I actually literally would get up in the morning. I would, go to class. I would in the afternoon, I would practice for golf. I would trade throughout those periods. And then I waited tables at night, and then I would literally get home late and I would do it all over again. Even when I was married, I'm married to my high school sweetheart. We started dating when I was 15 years old. She was a senior, I was a sophomore. and we've been together ever since. And she is truly the person that has had more impact on my life than anyone. But if you fast forward from that, in college, I decided I was going to go into the investment world. I started reading everything I could. It's one of the pieces of the puzzle I get asked all the time. Okay, what would you give somebody that's a younger you? I actually would say to my younger you, read even more than you did. I read 100 books in about a year and a half. I had to write my thesis. I had to wait tables. I had to practice, but I always was reading everything I could on the markets, public markets, private markets, value, growth, technical analysis, traditional fundamental analysis. It didn't matter. I read everything I could to try just to become a sponge. That then ultimately set me up for success when I came out of school. I was able to, fortunately get a role in one of the major investment banks when I was fresh out of school, was recruited quickly, literally about 6 months later to another firm, Paine Webber to start, Lehman Brothers after that, was there for 3 years, was recruited to Prudential Securities to start doing more of the executive services work that I became, more involved in. And then Oppenheimer came as well. And then I started the firm in 2001. But the origin story absolutely must contain Tony Robbins, because when I first graduated, one of the things I constantly was doing is trying to make myself better. And so one night, late in the evening, I saw this really large human being on television with big teeth and slick back black hair. And I listened to him for a little bit, like, oh my gosh, I absolutely want to learn more. I ordered the tape series. Lisa, my wife, and I, we listened to 30 Days, the tape series on cassette tapes, for those that remember those. We listened to them every day for 30 days. We did exactly what we were told. One of the days is a goal setting workshop. And in that goal setting workshop, I actually set a goal to within 10 years. This was December of 1991. I set a goal to within 10 years to start my own firm named CAZ Investments. It's going to be involved in private investments, public investments, and ultimately 9 years and 9 months later, we started the firm. I started the firm with the backing of several very prominent families in Texas, and I don't believe that 10-year time horizon is an accident. I set an outcome. Everything I did for that decade was, how will this help me set up my own firm at the end of that decade? And I say this all the time. Other than my faith, which is the most important thing to me, and my wife, which is the second most important thing to me, nobody's had more of an impact on my life, more than those two, than Tony Robbins. And I'm very grateful.
An amazing story, and there's a lot to unpack. I want to go back to sixth grade. What was your first job?
So I actually it was an entrepreneurial opportunity. It was really quite interesting. At the community pool, they had a snack bar, concession stand. And I actually really don't remember how I got the opportunity. I think I talked somebody into it, but I was like, a very mature, again, I was kind of the youngest 40-year-old walking around at, 13 or 12 or whatever it was, I literally said to them, I want to run the snack bar. I had to learn how to stock inventory, how to how to purchase wisely, how to staff and actually manage people at literally 12, 13 years old to be able to make that a very profitable enterprise. And it was. I mean, we made really good money. And I had other people that were my age. They just wanted to work there because they got to, hang out at the pool and look at all the girls and all that kind of good stuff. But we actually got to make some money doing it. And we had a lot of fun. And it just truly was an entrepreneurial opportunity right from the beginning.
That's incredible. Yeah, with somebody who has kids that are not too far away from that age, I can appreciate the maturity that is required to do something like that. So that was sixth grade, and then fast forward to you went to college and you made the comment that you decided you wanted to get into the investment world. But earlier you said, you were talking about how you grew up in a very kind of middle class family. Your parents were divorced. A lot of responsibility was placed on you at a young age. How did you first get exposed to investing? We talked a little bit about business in the sixth grade experiment, but why the investment world?
So I did get some exposure through high school, as they had, a pretty typical economics class to where you got exposed to the stock market and you got to do some things on paper, and have a little exercise. That was interesting to me. I was fortunate also that I just, had some other friends of mine, their fathers or mothers were involved in kind of the business community, not necessarily the markets at all, but the business community. So I was familiar with business, and obviously I'd worked in ice cream stores and I'd mowed lawns, and I'd done all these other things throughout my high school. In college, Lisa loves to tell the joke because we've been together since I was 15 years old. She likes to tell people she got me young enough to train me. There's actually a lot of truth to that. But so she loves to tell the story that when we got married, when I was 20 years old, we got married as soon as she graduated because we knew one of us needed to be out. But when we got married when I was 20 years old, I wanted to be a golf professional. So I obviously was really into golf at that point in time, and I was, successful, but I was not that good. But even if I didn't make the PGA Tour, I was like, I want to work in a golf shop because I was waiting tables at a country club there. I was like, this is a really cool environment. Now, anybody who knows how little golf professionals make know that Lisa married me because she loved me, not because of the fact that she expected to go make a whole bunch of money by being my wife. She married me because she actually loved me. But the next fall, I was exposed to a couple of different things, one of which was a class on agricultural economics that had a very significant amount of hedging taught as part of that. And that gave me this direct market exposure. But I was fortunate I was able to have a kind of a customized degree plan. I was able to take whatever class I wanted to take as long as I could justify it to a panel of academics, of professors from the various colleges. So effectively, what I wanted to do at that point was to explore different things. I took a class on financial planning. It's like I could use this at some point in my life, hopefully. So I took that and I literally just loved it. I loved the trading and I loved the understanding of how, financial matters worked. And I ultimately was able to say, I think this could be really fun to put it together. So I, morphed my degree plan to become basically a double major. It's not technically this, but a double major in finance and economics and a double minor in speech communications and in psychology. And so I was able to do all of that. But while I was trying to figure out how to pay for my school, trading became a big part of it. That kept me involved in the markets every single day. And as everybody knows in the markets, you can never learn enough about it. And so I started reading. I read book after book after book. And the more I dug, the more interesting it became. And the more it was clear that, I believe that I was designed to be, my skill set was designed to be in this industry.
We didn't go over this before the call, but I'm curious, what would your classmates have said about young Christopher Zook, if they knew you, you were clearly mature and advanced beyond your years. Like, what was that? Who were you to them?
It's interesting because, we've had enough reunions now, and I have still friends that, were in my wedding and people that I went to high school with and in college as well. I was never really that engaged. I was in a fraternity. I had a good social friend group. Lisa and I were together, right, from the time that I was a sophomore. So for me, my life was much more about our relationship and her friends and then some of my friends as well. So I think what they would say is that Christopher always was driven. He was always very intense. I mean, whether you talk about on the football field or you talk about in business or even in education or even waiting tables, I was an intense fellow then. I'm an intense fellow now. They would probably say he was always wired to work and he was always wired to try to just make things happen. The other thing I think they would all say is that Christopher did not take no for an answer very well. It was not something that, fit his design. And so I literally was always trying to figure out how to accomplish what I wanted to accomplish, which is why I think I resonated so much with what Tony teaches is, so much of what we decide to do is the way that we feel, the way that we think, and the words and the vocabulary that we use. That was always really kind of who I was before. And I think that's what they would say is that, he was always kind of built to do something like what I've done over the last, almost 40 years now.
Incredible. So you mentioned Tony Robbins a few times, and I know he's been a big part of your life. And you said, one of the most important people in your life. How, let's talk about that relationship because you first were exposed to him through the cassette tapes in the 30-day class. But, what did the evolution of that relationship with Tony Robbins look like? And I know that you've also recently put out a book together, I believe a New York Times bestseller. I have it and I've read 2/3 of it called The Holy Grail of Investing. It's fascinating and it's super clear in terms of how you think about investing, which we'll get to. but I'm curious to better understand kind of how you got to know him, because your relationship today is very different than it was, 30 years ago when you were first exposed to him.
So in 2000, I'd always followed Tony from 1991 on, and so much of what I accomplished and what I achieved was based off of following a roadmap, effectively, that I'd built, with his guidance through a cassette tape. I had not gone to any of the live events, and in 2013, I coached high school football, and my son was going to graduate in 2014. And I was like, okay, I need to figure out, okay, what am I going to actually do from a business perspective? I was running the business the entire time. I ran a charity. It was a very large charity here in Houston. And so I, didn't miss many hours of the day of productivity, but I really, really wanted to get better. And that's just kind of the same theme if you think about it from when I was in high school all the way to today. How do I continue to get better at what I'm doing? And so in 2013, I went to Business Mastery, which is his series where he brings together a whole lot of expert speakers on different types of areas of business. And just to be blunt, in 6 days, because it's exhaustive, like think 18 hours a day for 6 days, I learned more in that 6 days than I did 4 years in school, simply because it was practical application as opposed to philosophical or conceptual application, which naturally is what a university is going to teach. So I learned much more about marketing and much more about the actual running of a business, about how to hire. I mean, the first 12 years of the business, candidly, and I readily admit this, I was a horrible hirer of people. I just was hiring people quickly and I was firing them slowly. And that was just a terrible combination. I made so many mistakes that you would expect a 31-year-old to make, if they start from scratch without a lot of extra training. In my case, 2013, it became very clear that I needed to get better at those things. So I did, Date with Destiny in 2013, technically, and then Business Mastery immediately thereafter. And it totally changed my life. I mean, it really, really did. And people say that all the time. "Oh, I went to a Tony event and it changed my life." Well, it actually does. And for those who've never been to those events, you can't appreciate until you've been in that environment. And that is strictly just something. I literally was a different person when I came home from Date with Destiny. And then our business has never been the same since I went to Business Mastery. So I then proceeded to implement a lot of those kinds of things. Well, one of them is the irresistible offer. And Tony talks about this a great deal. In the irresistible offer, it's like, how does somebody not really have any reason not to do business with you? So in our world of investing, and I know we'll talk more about this, but we wanted to be aligned as much as possible to where somebody would not be able to say, I don't want to invest with them because of this reason or that reason. Take all that off the table. So we had always been the first investor in everything we do, and we'd always been the largest investor in everything that we do. But most people didn't know about that because we didn't market well, and we didn't market really at all. But I was like, how do we change that? So we literally started charging no management fees and just carried interest. And the irresistible offer is that if we are the biggest investor in the fund and we don't get paid unless you make money, it doesn't mean it's going to work, but it means we are aligned. And so from there, we began to really accelerate our growth. And I actually started hiring slowly and firing quickly. It's amazing how much better that is. And then hiring using good tools and training with good tools and being in a position to take advantage of what had always been a fantastic track record and actually telling people what we do and why. And then from there, to just make sure I close the loop on the Tony question, is in 2019, basically, one of our investors, who is a former hedge fund trader for Paul Tudor Jones, who Tony Robbins has had a great relationship with Paul Tudor Jones going back to the 80s, literally told Ajay Gupta, who was Tony's financial guy, if you will, told AJ, there's this group in Houston, they're doing something really, really unique. They kind of kicked the tires a little bit, didn't understand it. They go, wait a second. Oh, we can actually own a firm, not just invest in a fund in our GP stakes business. And yeah, absolutely. Let's do that. And so one of our partners literally knocked on my door one day and he says, by the way, Tony Robbins just became a client. And I was like, Tony who? I was like busy. I was, thinking about it. And I was like, Tony who? He goes, Tony Robbins. And I said, okay, well, who's he? And he goes, no, you don't understand. The Tony Robbins, because everybody knew I quoted Tony all the time, what we call Tonyisms. When would now be a good time? And, repetition is the mother of all skill. I mean, I say them all the time. Between football analogies and Tony analogies, it's just pretty much all my team hears. But he says, the Tony Robbins. And I'm like, whoa, how in the world did that happen? Because I wasn't even involved. So Tony got more and more interested in what we were doing. I met with AJ and Tony's son, Josh, in the middle of COVID, literally in 2020 in San Diego. They didn't know anything about my origin story. They didn't know any of my connection, that I'd gone to Tony events or that I'd been, a student, if you will, for 20 plus years at that point. And I'm like, okay, we got to tell Tony this. Tony found out about it, flew to Palm Beach, had a marathon meeting with Tony. And by the time that we left that meeting, we decided we were going to be partners. And then ultimately became the GP stake firm, if you will. That's what we're kind of known as. We actually sold a GP stake in our firm to Tony, AJ, Josh, others. And from there, we were able to, nobody took any money out. It was all put on the balance sheet to help us grow and to help accelerate our growth. And then from there, we decided that we'd write the book together. And it's been an amazing journey that I'm so blessed to be able to have experienced. And they are fantastic partners in every way that you would want them to be, absolutely as helpful as they can be in every way. At the same time, not coming in and telling us how to do what we do. It's been a great combination, and I'm very grateful.
So you mentioned one of the things that you learned to do and that you were doing is telling people what we do and why. So let's transition to CAZ Investments. What is it that you do and why do you do it at CAZ Investments?
We've always been focused on where's the best place to put our own capital. And I will tell you, there's a lot of lip service to that people say, oh, yes, we're invested in our own thing. We always have been that way, and it's always been the key driver. What I tell everybody is my dollar, Lisa and my first dollar, will be the first into every single thing that we do. And collectively with our shareholders, our firm, our team, we will be the largest investor in everything we do, at least, for the foreseeable future, because we, don't know how big that could be, but just say, never say never, never say always. But we have always been the largest investor in everything that we have done. What's different about us, and I think it is truly unique in the marketplace, is that we don't ever have to deploy a dollar. Never. We can always choose to do nothing. And so when we choose to act, it's because we believe it's a really good idea for our personal capital. But then what we will do is we'll open it up to our entire network to be able to come alongside us in whatever it is that we choose to do. And candidly, I think it's worth telling because there's others that probably watch this that maybe can benefit from my mistake. So for the first 12 years of the firm, we really never told anybody what we do. We had a great track record. I mean, a really solid track record. But I kind of took the Field of Dreams model and just focused on the investments. Like, we make great investments, they will come. Well, folks, I can tell you, they don't come unless you go get them. So, Peter Drucker's famous for quoting, this is one of the things I learned at Business Mastery, and it was like this aha moment with another aha moment that I'll come back to. But Peter Drucker's always said that innovation and marketing are the only two things that make up a business. That's all it is, innovation, marketing. Well, we were really good at the innovation. I mean, world class in the innovation. We shorted subprime in 2007 with John Paulson. We bought all these wonderful assets in 2010, 11, 12 that were so inexpensive in real estate and credit and financial institutions. We were great with the innovation, but we were horrible at the marketing side of it. We basically didn't try. And then one day I'm literally in the locker room and a gentleman about 20 years, my senior, I'd played golf with him maybe a couple of times. He basically threw me up against my locker. And I mean, got face to face with me. I'm like, I don't know what I did. I apologize. I'll fix it. And he goes, I am so upset with you. I'll clean this up for broadcast here. He says, I am so upset with you. I heard you shorted subprime. This was in 2013, 14. I heard you shorted subprime with John Paulson. I said, yes, sir. And he said, why in the, you fill in the blanks there, didn't you tell me you were doing that? And I said, you're not a client of our firm. You're not supposed to prospect in the locker room. That's a real thing. Why would I tell you that we were doing that? He says, you do not have a blankety blank, blank, blank right to tell me what I want to do with my money. You tell me everything you're doing and I'll make a decision. I said, you know what? You're right. I apologize. It's not for me to not tell you. You want to know? I'll tell you everything I'm doing. You make your own decision. Well, that was a seminal event for us. I mean, it was a turning point event for us, like really no other, because like he's right. We do some of the coolest things in the entire world, and yet we're going to just keep it to ourselves. No, what we do now, we started then, is we let everybody know that's in our network and our ecosystem, and the people can make their own decision. If they want to invest with us, they can. If they don't want to, that's fine. But because of the fact that we never have to invest capital, because we can go anywhere to invest in anything at any time, we have the flexibility to be able to go where we believe it should be best invested. The way we do it is important. We're a thematic investment firm. We follow a theme. We find the best risk reward to take advantage of the theme. And then from there, we're going to find the right either vehicle, partner, or methodology to be able to maximize the opportunity from that risk reward. And so for us, everything we've done is based on a theme, literally going back almost 25 years. Next year, really proud of it. It's going to be our 25th anniversary. But 2007, it was because we believed the housing bubble was going to burst. And I mean, I believed it with every bone in my body, just as much as I did in 2002. And you can all go to our website and you can read every quarterly letter I've ever written all the way back to 2001, which candidly is terrifying because of the fact that you're going to see everything good, bad, and ugly. But we have been much more right than we've been wrong. But you can read in 2002, we wrote a special message to everybody that it was the buying opportunity of our generation. Well, in 2007, literally, I was talking about all the time about this housing bubble is going to burst. There's no question. I didn't know how to short a house. So I already had a relationship with John Paulson going back to 1994. So learned what he was doing. He explained it to us. Took me a while to figure out what he was talking about, candidly, because I didn't have Selena Gomez to explain it to me like in the Big Short movie. But it's something to where we then created a vehicle for our shareholders and our investors to be able to invest alongside of us and to be able to make that investment. And that's true in everything from the shale revolution in energy to what we're doing in cord cutting in professional sports to what we're doing in GP stakes. Everything is based off of a theme and then the best risk reward way to take advantage of it.
Your transparency is interesting because I think in our industry, well, two things you said are really interesting. One is your transparency and the alignment that you drive where there's no management fees, only carried interest. And then the second is the quote that you cited from Peter Drucker of innovation and marketing make up a business, and how you talked about how you were really strong in innovation, not at marketing. I think, both of those are systemic challenges for a lot of people in private markets. So taking them one by one, when you think about transparency, how do you think about, the typical rebuttal that I would hear anytime you utter the word transparency is, yeah, and I'm worried about my competitors beating me at my own strategy or my own game. How do you kind of react to that rebuttal?
I would say it two ways. Number one is at a certain time in our career, I was much more concerned with that. And at a certain size of our business, I was much more concerned with that. So I definitely understand where people are coming from. It's a little different for us than the way that it would be at somebody who's doing a very specialized strategy, that it is maybe truly a secret sauce. For us, we'll tell everybody what we're doing. If somebody hasn't figured out that healthcare for an aging demographic is a good idea to invest in healthcare, then yeah, I can't help them. But so I'm not worried about that. Who we invest with, all of that, we did guard that a little bit more at a certain size. The advantage we have now is we're investing such large sums of capital that it gives us just the ability to do things that other people can't do, or even if they can do it, they can't do it the same way we do. I mean, it came out 3 weeks ago now that we wrote, CAZ Investments wrote the largest private equity check last year that was done worldwide according to PEI. So literally $1 billion check into a single fund in one investment. The next closest was 600 million. And so people think of this sleepy, Houston-based firm. Well, folks, $1 billion is $1 billion. And we are a Wall Street firm. We just happen to be based in Houston, Texas. So when we think about what that does for us, it shouldn't surprise anybody that when we write $1 billion check, we don't pay the same fees or get the same terms as somebody who's not writing $1 billion check. So we have much more preferential terms, co-investment rights, right of first refusals, all kinds of things that you would expect any very, very large institution to be able to do. I mean, literally the numbers came out last week. We're now 117th in the world allocator to private equity. And that's a number that gives us a lot more flexibility. It's larger than a lot of endowments and many even public, pension plans. Well, transparency in that regard is much less of a concern for ours. How we structure some of our investments, we do guard a little bit more carefully, but we want to tell everybody what we're invested in. And sure, our presentation materials are supposed to be confidential. We know that they hopefully are guarded carefully, but they find a way out. And what we do is different. And what we try to tell people is that it may be simple, but it's not easy. Okay, what we do, it takes consistency, it takes predictability. Another thing that I think really differentiates who we are, and it's going to be tied to your question a little bit, but it's a little bit off of it, is that we focus so much more on the downside. I mean, our firm adage has always been the same. We absolutely focus on what's the worst case scenario, how do we get hurt, how does somebody do us wrong, what could blow up in our face, etc. Because if we can live with that worst case scenario, the upside will take care of itself. Well, for literally 25 years, we did this when the book came out. Very, very, very thank you for your comments, by the way. Very fun opportunity to be able to, write that book with Tony, to be able to interview the people that we interviewed and make it something that people have, experts in the industry that have been in the industry for 50 years and people that don't know anything about what a private equity even, term means. We tried to write it for everybody, and obviously, people agreed, and we were very well received. But the most interesting thing in anticipation of that is we needed to figure out, okay, what might somebody attack us on? So we did, a whole lot of things to make sure we were prepared. And one of the things that surprised the heck out of me, I really did not expect this at all, is that we went back and we looked at every private investment we've ever made as a firm. So today, literally on every realized and unrealized investment that we have made over the last 24 plus years, we've made money on 95% of those investments. Now, some people may have made more money than us. I'm sure there are, but I'll put that batting average up against just about everybody. And it's that predictability and consistency that means, sure, we're telling people what we're doing. We're very transparent about that because those kinds of things don't cause us to succeed or fail if somebody knows that we're investing, inside of GP stakes or what we're doing in energy, et cetera.
So you mentioned 117th allocator to private equity in the world. Do you consider yourself, I mean, it's so funny because in my world, we talk about LP and GP, and you raise money from outside investors and you invest that in your own money, and you invest that money into or alongside other investment managers. So where do you kind of put yourself on the continuum of allocator, investment manager? How do you describe yourself to others?
It's a very common question that people try to put us into buckets. Oh, you're a fund of funds. No, we're not really a fund of funds. Do we invest in funds? Yes. But we also do co-investments, direct investments, secondaries. We do everything pretty much under the sun, and we don't have a fee on a fee. So you don't have, this extra layer that people have to think about. In many cases, we are actually less expensive if somebody invests with us than if they go directly to a sponsor. So that's just our size and our scale enables us to do that. And so we're not that. We're not a wealth manager. We don't do any planning. The wealth managers are our clients. They actually invest their clients' assets into our vehicles. We're not a multifamily office. Do we have, a shareholder list that looks like a multifamily office? Yes. But we don't do wealth planning. We don't do estate planning. We don't do tax planning. We don't walk dogs. We don't charter aircraft for people. We don't do any of those services. Those are important services. We just don't do this. We're an investment firm. So the interesting thing, we actually have a slide that we show we're 117th largest allocator to private equity in the world. We're also the 263rd largest manager of private assets in the world because we are a GP. We do manage funds. We have over 90 different vehicles, and we're also a limited partner alongside other people. So it's always this big debate. The way I explain it to people is we're like the merchant banks of the early 1900s, which means we're more of just a pure investor, and we'll do so in whatever form makes sense. But the bigger the network gets, the bigger the checks that we can write. We now have over 6,000 investors in all 50 states and 36 countries. And so and again, it doesn't happen this way, but if every single investor, we had 6,000 of them, all decided to do one thing at the exact same time with us, the check size could be $10 billion or $20 billion or even $50 billion, and it wouldn't even be a big deal. Now, again, not everybody's going to do something at the exact same time, but when we put together 1,000 investors to make a single investment, it's a needle mover, and you can write $1 billion check. And that's something that just gives us that flexibility to be an allocator of capital. At the same time, we're a manager of capital, and we do have things that we do that are proprietary, and we have things that are partnered with other people. So investment manager is really the only moniker that applies.
So let's talk about some of the themes that you're most excited about. I know when we were, chatting earlier, we talked about, and you've mentioned GP stakes. We've talked about the secondaries market. I think sports is super interesting and, not very well understood. Maybe give us the kind of quick harbor cruise, if you will, of some of the different themes and what you like about them, and then we can unpack them in a little bit more detail.
So we have four major themes that we're focused on right now: the growth of private assets as an asset class, the disruptive technology that's obviously changing our world, the change in consumer behavior that is occurring in our world, and then what we call the energy evolution. So to unpack them per your request, GP stakes, it's all about the growth of just private assets. You got 401ks that are coming. They're coming and they're coming in a hurry. It's going to be massive opportunity for new capital to move into the private markets. The average high net worth investor has 3% of their portfolio in alternatives. The average large family office has 40% of their assets in alternatives. They're going to catch up. That's why you see so much of a movement to the wealth channel. You add institutional investors that are underallocated, and you look at a theme that is very easy to predict, which is there's going to be more money in private assets in 5 years than there is today by a significant amount. We felt like the best risk reward was to own the firms that actually are managing those assets, because it's better to receive the 2 and the 20 as opposed to pay the 2 and the 20. So we love owning those firms that are going to be the beneficiary of the growth of the asset class. In the case of cord cutting or change in consumer behavior, it is cord cutting. So how do you take advantage of that? Not a lot of ways to do it. We felt like live events were the right way. So live events are dominated by sports today because of cord cutting. So if you want to be an advertiser and you want to reach your audience, how are you going to reach them? You pretty much have to go to a live event to get them to watch your commercial. Or you can micro-target them on social media, but to get a large bang for your buck, you've got to go to these large audience events that are live. Well, in 2005, if I remember correctly, 13 of the top 100 most watched live events were sports. In 2023, 97 of the top 100 programs that were watched were sports. Little tidbit, 94 of the 97 were the NFL. So the growth of the live event need for advertisers is the investment. Well, the only way to do that is to own the sports teams. That was impossible until literally 2019, 18, 19. So now we have the ability across all of the major sports leagues in North America and then globally as the opportunity presents itself. And so we own now over 30 different franchises, minority stakes in over 30 different franchises. So that gives us this incredible diversification and get to own some of the most unique trophy assets. Literally, the term trophy asset is from the sports world. That obviously is what we get to own. In the case of the change in disruptive technology, don't need to spend much time there. Everybody gets it. We were early investors in OpenAI, ChatGPT, early investors in Anduril, early investors in so many other names through our 25 years of relationships in Silicon Valley and the connections and relationships that we have there. In the world of the energy evolution, we believe in all of the energy. The saying is really this: we're for all energy and we're against all poverty. So as we continue to grow population and as people move up from lower economics to mid economics to wealthy economics, they use more and more energy as they go. And it's going to take everything. It's going to take traditional fossil fuels all the way to solar and hydro and wind and everything else in order to be able to meet all of the demand that we have. And that was before AI became a big deal. And now obviously the surge in demand for data centers and things of that nature. But so we have a unique position there. We're based in Houston, Texas, energy capital of the world. So we have great relationships and we invest in a lot of other things, but those are our four primary themes right now.
So each one of these in itself is like a massive, area of exploration for investment with, hundreds or thousands or maybe even sometimes tens of thousands of potential investment opportunities. How do you think about kind of the filter or the lens that you apply to deciding, you know, number one, how do you get to your themes? And then number two, within those themes, how do you identify the right managers, the right way to participate in the theme that you've identified?
The top part of the theme is probably the hardest for me to explain to people because there's no formula for it. And, investing is really serious science, but it's also art. And there are, without question, investors who are more heavily art and more heavily science. We are certainly a blend of both. But when it comes to identifying themes, a lot of it just comes from been there, done that, and doing what I consider to be one of our strongest suits and our strongest skills as a business. And that is removing emotion and not getting caught up in the crowd. I actually really think this is a big advantage we have of being based in Houston, because when I go to New York or I go to San Francisco or I go to Chicago, groupthink is a real thing. And there's obviously brilliant people there. But if all you hear about is this, and this at lunch and at dinner, at cocktails and all the things that you're doing, okay, you tend to start to move together as a collective group. It's only natural. We don't have to do that. And so we're able to sit there like we were, and I'm on public record in many, many places saying this at the beginning of 2024, when everybody said the Fed was going to aggressively cut. And I said, no, we're going to be higher for longer because of the fact that this Fed understands what happened from 1978 to 1982. They've studied history. They understand they cannot move too quickly, because if they do and inflation spikes back up again, it'll be much worse for the economy. It'll destroy their credibility. Well, how did I know that? I wasn't in the business in 1978 to 1982. It's because of the fact that I studied it, I read about it, I understood it, not just part of my academic studies, but actually because of all the books that I read. I was able to truly see and understand and not get caught up in that emotion. Many people, literally were hoping that interest rates were going to go down. And so they started talking their own book about, well, of course interest rates are going to go down because it's going to be good for me. Well, you know what, folks? Hope is not a good investment strategy. So what we really have done a great job of is being able to be very clinical, unemotional, and just look at the facts and just look at the data and look at the statistics and not let anybody else's opinion sway us from what the data and the facts show. Again, no different than the tech bubble in 1999. I'm on the record many places of calling that. Didn't get it to the day, but I got it really, really close. In 2002, the buying opportunity of the generation, part one, actually, because part two was, you can again go to our website. You can see in March of 2009, I wrote an email or a letter to all of our investors at literally 2:30 to 2:30 in the morning from a hotel room in Boston after the S&P broke through 700 for the first time in decades. I'm like, this is tilt, folks. If I feel like I'm sick to my stomach, the average investor is just completely frozen. I don't know if this is the right time, but this is the buying opportunity of our generation, part two, back up a truck. And you can read through, and I think people can learn a lot from reading 24 years worth of quarterly letters to be able to see what we were thinking about, where we were early, right? Where we were late, but how the thought process got there. So the themes themselves sometimes come to us because of our network. So when the people in the energy world here in Houston were talking to me about shale, it was like, okay, you're talking about like granite countertops? I mean, what are you talking about? No, it's really a big deal, Christopher. You need to understand the differences of rock and how we can get to it. Very short version, we did our homework and we said, this is a really big deal. And so we started investing aggressively into how to benefit from the shale. But I'll use that as an example to the part two of your question. Well, how do you decide how? Right? Well, I use the term a lot with our team of first derivative, second derivative, third derivative, et cetera. So, an easy way to benefit from the shale revolution would be just to buy exploration companies that are drilling for oil and are going to find oil or gas because of the shale revolution, the new technology that was out. Okay, that's a first derivative. It also has the largest amount of risk. because people were paying, at the time, we thought, crazy money for leases to be able to get the right to drill in areas. And we were like, this could end really badly. If prices come down, this could be bad. As it turns out, it would have been fine. But we felt like the picks and the shovels, the second derivative, providing transportation, providing processing, providing the ability to get from the wellhead, very close to the wellhead, to actually the central hub of where it was going to be processed and go, for those that don't know energy, downstream, which means to your gas station or to your home or wherever. So we wanted the midstream assets close to the wellhead. That's not the publics at that point, because the MLPs do great for long haul transportation, but close to the wellhead, that's primarily new niche private equity backed companies that were finding a need, they were filling the need, and they were getting paid. It's actually another firm adage. So we felt like that was the best risk reward. So that's where we leaned in. In the case of sports, as an example, where you have cord cutting, that's what we want to take advantage of. The best risk reward is to own a piece of these things called a legal monopoly that are professional sports teams in North America. Nobody's allowed to compete with them. And people don't realize that when you own one piece of an NFL team, you own 1/32 of the league itself. Whether you're first place or last place, you still get the same distribution check, which it's all public record. But last year, approximately $400 million was the check that every single owner in the NFL got before they actually went out and played a game or sold a ticket or whatever, right? Plus all the other benefits that sports have as far as low correlation, et cetera. And then the ultimate risk reward, and I've been quoted as this many times, the best risk reward that I've seen of nearly 40 years of investing is owning the part of an investment management firm in the private asset world. So, in a hedge fund, in an enterprise software company, in any other kind of business, it's sticky money, but they can actually eventually get out if they really want to. If somebody invests in a private equity fund, they can't get out. They're contractually bound. They literally are there until they're not. That management fee income to the firm is going to continue regardless of how they do as a firm. Now, eventually, you got to perform, but the risk reward is so good because of that. So finding the risk reward is what I think is where our science gets so good of focusing on what's the worst case scenario. If we can live with that downside, the upside will take care of itself. And then from there, it's finding the right team, the right company, the right opportunity. So another really fun example to talk about is Icon. Icon is a 3D printed home company based in Austin, Texas. For those that haven't ever heard of it, you can actually print a house now with a 3D printer. It's concrete, can go up in a matter of days at a fraction of the cost of traditional construction. Outside of Austin, there's a neighborhood Lennar Homes is building, all of which with Icon printers. Literally, you can buy them right now. But we were seed investors in the company. And we saw that the technology that was being built was truly going to disrupt the entire landscape of how homes were being built, and also that it might just help solve a lot of the housing crisis that we have and the homelessness problem that we have, as well as after natural disasters and things of that nature. You can drop literally a printer into an area. It can work, all around the clock to build homes, to put people back into a safe environment. So we love those kinds of opportunities, but you have to be able to look at a lot of things and to be able to say, okay, what is real? What is not? Our team looks at 1,500 investments a year, and they all can tell you the same thing. We will be the fastest no in the West. If it's not a fit for us, we're out. It doesn't make it a bad investment. If it doesn't fit a theme, no interest. If it doesn't have a great risk reward, it's positively asymmetric, no interest. If it's something to where it fits those two criteria, we're going to dig in and we'll be very, very scientific about the way we do it. But then ultimately, the power of the network is the network. We have the ability to ask and to get great references for people like, okay, I love to ask this question. It's one that you can use in the future, that if you could only give your money, you weren't allowed to manage your own money, but if you could only give your money to one manager, and that's literally all your portfolio is going to one person and their strategy, who would you give it to, right? And people will answer that. You start to be able to triangulate. And then if you ask that inside when you're looking at a particular theme, it can help you identify those things. But then ultimately, it comes back to where it always should, which is trust, relationship, confidence, and the word, people talk about all the P's. Okay. There's only one P that matters to me, and that is persistency. Can somebody persistently deliver the results that they say they can do by accomplishing, what basically other people might be able to do, but not as predictably and not with as much persistency as a particular team or a particular company or a particular strategy?
So at this point, I'm sure a lot of people are wondering, how can I get on Christopher and CAZ's radar? But before I, go into what's the best way to learn more and, kind of concluding thoughts, I want to pick apart two more topics. So one is just to clarify, when you're making these investments, how are you doing it? Sometimes you're investing in the companies that own the assets. You'll invest in. Sometimes you're investing directly in the companies, like in Icon, the example that you gave. I mean, what's the range of the way that you're able to invest based on what you've agreed to with your clients, your investors?
So the advantage I think we have is that we can go wherever to do whatever, whenever, right? So we can go in the public markets to take advantage of our thesis, which we do frequently. When things get dislocated enough and prices get completely out of line, we can do the public markets. We can go in the private markets directly into a company. We can do a co-investment alongside a sponsor. We can do a secondary transaction, or we can do a primary commitment. Secondaries is an area that we're really excited about right now. As an example, we've been told by people who should know that last year we did the largest limited partner-led secondary transaction that has ever occurred in the world of GP stakes. It was over a $500 million net asset value transaction. We wrote one check, bought the entire piece at a very attractive price. It was good for the seller. It was good for us. It was good for the sponsor. We are very, very active in that regard. So we can go, those assets weren't available anywhere else, but we could access those in many cases that are not really truly available anywhere else in the world. You can't buy them, but we were able to buy them through a secondary transaction. And we will do that across all of the areas of our themes. We've done it in sports. We've done it in energy. We've done it in every other area that we invest in. Secondaries are sometimes a great way to go. Sometimes it's better to actually be a part of the origination and be part of the icon as a seed investor in the company and everything in between.
So the last thing I want to touch on is, the composition of your investor base and what you've been able to build. I think you mentioned before that you have 6,000 investors. Is that right, roughly?
So yes, we have 6,000 investors, and there are a wide range of types. So investment advisors who use us for their clients are our largest, kind of segment, if you will. That's where a lot of the quantity comes from. Institutional investors, hospitals, universities, large family offices, and then just high net worth families. It runs the entire gamut across all of those types. Our fastest growing typically is the investment advisors that are using our vehicles that they can't get anywhere else for their clients.
And one of the themes that I know that you're passionate about is we share a passion, or at least our companies share a passion, which is around broadening access to private markets. Maybe talk to me a little bit about some of the initiatives that you're working on that relate to enabling individual investors, sophisticated individual investors, to have access to privates, and why that's important to you.
Mm-hmm. So in our case, the book was the big catalyst for us. For everything we've done for 23 years, it was for qualified purchasers only. That was it. That was our target market, no exceptions. Very few exceptions. There was a couple of things we've done over the years, but very few. When Tony and I were writing the book, we're very passionate about the democratization of access. We don't believe that somebody should be able to invest in the best investments simply because they already have a lot of money. We believe that everybody should be able to invest in that as long as they understand them, as long as they have good counsel, or they're able to, show that they have the expertise to be able to do it. So we've been very active in helping to promote some legislation that's currently going through Congress, which would instruct the SEC to be able to actually create a test that people could take to become an accredited investor. They wouldn't have to meet the income test or the net worth test. They certainly can, but they would be able to take a written test if they did not meet those other criteria. So we 100% wanted to make available to people that were reading the book. We knew that 90% of the people that read the book would, just by statistics, not be qualified purchasers. So we created a registered fund that would enable accredited investors to be able to utilize the exact same investments that we do, to invest in the exact same things that I invest in personally, that Tony invests in personally. And everyone literally has the ability to use that, particularly investment advisors, for their clients that fit in that criteria.
Let's just say the legislation passes, we see a broadening of access to private markets. What do you anticipate might be kind of one of the biggest challenges from the time when investors are able to invest to actually making their first investment if they've never had access to private markets before and now they do?
Access is a big part of it, is being able to actually find what they're looking for. One of the fears that is out there that I also share is that every locker room deal that gets passed around, that people like me and our team have completely passed on 15 times, that they go, oh, I can now, so I should do that. No, don't do that. Please don't make an investment because you can. Make an investment because it's the right thing for your portfolio and because you actually understand the strategy and the objectives of what's being accomplished on your behalf. So it's critical that you look for credible firms that have been there, done that, and not go with somebody who's, first rodeo, so to speak, to use the Texas phrase. You really want to make sure that if you can, that you're smart about how you go about doing it. So there's a lot of ways to go about that, but the number one thing is to be sure they're credible, they've been there, that you actually understand what they do and why they do it. Don't invest in a black box because somebody says, oh, I got this great track record. Look how good it is. No, if you can't understand, Mr. Buffett says, if you can't understand the back of a napkin, then you probably shouldn't make that investment. So the world is more complicated. Just because you can do something means that you don't have to rush into it. Take your time. Get a lot of education, read everything you can. Obviously, I'm biased. I think our book is a great place to start. We wrote it for that audience specifically. And so from there's a lot of other great resources that are out there. And then from there, the most important thing is to make sure that you properly diversify. Don't just buy one asset class. Don't just buy one investment in an asset class. Be sure that you're following what it was a tag of a tip of the hat, if you will, from the book, The Holy Grail of Investing. Ray Dalio's made that phrase, famous. It's really Markowitz, modern portfolio theory, but it's 8 to 12 less correlated asset classes can help you actually reduce your risk and potentially increase your return. That's why you won the Nobel Prize, because that's not intuitive. But you must have the diversification in order to accomplish that. So it's very important to be able to find a way to get exposure to everything that we've talked about. And you can, if you know where to look and if you talk to the right people. Obviously, for us, we'd be honored to have you invest with us and to talk to our team or talk to one of the advisors that we work with, et cetera. But certainly, you should make sure you look at a lot of things and then decide what's best for you.
Christopher, we could go on for hours. This is so fascinating. I'm loving every second of it, but we're out of time. If people want to learn more about CAZ Investments, if they want to learn more about the opportunities that you have, what's the best way for people to get in contact with you or a member of your team?
So CAZinvestments.com is by far the best place to go. You can get so much information there, right there on the website about what we do for accredited investors, what we do for qualified purchasers. If you prefer, feel free to email us, CAZteam@CAZinvestments.com, CAZteam@CAZinvestments.com. But CAZinvestments.com is going to be best for you because you can read white papers and learn, okay, why would you want to own a professional sports team or a GP stake right there on our website.
Well, thank you so much for joining me today. I enjoyed the chat and I look forward to continuing to watch your journey.
Thank you so much. I appreciate you having me.